Lynn, hi. How are you?
Pretty good. Happy to have another conversation.
Yeah. Do you know how many we've done in total?
I actually don't know how
30.
many.
This will be 37.
Really?
37. Yeah, 37.
That's much more than I would have guessed.
Well, we did about 14 in one year once.
That's
Uh,
why, yeah.
but I thought in Norway that was our going to be our final What Bitcoin Did show together. But
Yeah, we couldn't let that one be the last one. We had to do one more.
you're actually 4.4% of all the shows we've made, and a high percentage probably of downloads. But yes, with we needed an emergency Lyn Alden broadcast. I went to
Lots of stuff going on.
Lynn. I went to bed the other night, and Bitcoin had dropped a bit, and I was like, okay, well, look, this happens, calm before the storm. And I woke up, and I have an app that gives me the price, and I just had a look, and I was like 50K, and I was like, were we at 60K or were we at 50? Like, it was such a drop. I was like, is this in pounds? Is my mental model wrong? And I called up Danny. He was like, oh no, because he's obviously in Australia. He's like, oh no, Japan's collapsed. Japan's finished. Japan's done. Everything's over. Uh, what the hell happened?
So a lot happened. The biggest one is that the carry trade had a deleveraging, which is a lot of jargon, but basically, because Japan has unusually low interest rates, a lot of investors, both Japanese and foreign, borrow yen for nearly zero interest, and then they use it to buy other assets, including things like U.S. Treasuries or U.S. stocks or just assets in general. If you can borrow from a low yielding currency and you can invest in a higher yielding currency, especially one where the currency itself also appreciates compared to the yen, then that's a very attractive trade as long as the yen keeps devaluing and as long as that interest rate differential remains where it is. The problem is that the yen got so weak in the past couple years, and Japan occasionally comes in and intervenes because unlike a failing emerging market, they actually have a lot of firepower to protect their currency if they want to. They have huge foreign exchange reserves. They have a ton of foreign capital that they can pull back. And so they kind of, for most part, letting the devaluation happen. But whenever it gets too quick or too disorderly, they can go in and break, various kind of speculators and shorts. And in addition, they've actually tightened their monetary policy to. It's funny. It's only 0.25% interest rates, but it's the tightest they've been in quite a while. And the combination of these actions put a lot of appreciation on the yen in a very short period of time, which is a problem for people that borrow the yen if they were over leveraged. And so we got a pretty massive deleveraging event across global markets as that partially unwound.
Okay, loads to unpack there as well. Okay, so why has the yen currency been in trouble? And if they've got a lot of firepower, why haven't they used that to strengthen the currency and turn their economy around?
So a couple reasons. One, it's been weakening because you don't get interest rates that are comparable to what you get from other currencies or compared to the money supply growth rate or inflation. And so basically, Japan, and I talked about the subject of fiscal dominance, which is to say that when a lot of debt gets piled onto the public ledger, countries start running into an inability or they get a lot of consequences from raising rates because the normal reason why a country would raise rates is to either make their currency more attractive compared to other currencies and therefore strengthen the exchange rate, or two, to slow down the rate of bank lending. Um, because that's usually the dominant force of money supply growth. But there are certain eras where fiscal spending, fiscal deficits are a much bigger factor than bank lending. So Japan does not have excessive bank lending, so there's little reason to raise rates in response to that. It's mainly about making their currency not terrible compared to other currencies that people can hold globally. And so they've because they have more public debt to GDP than any other country, they're deeper into fiscal dominance. They have much more problems raising rates. And so while almost every other country has raised rates, tried to get a positive real rates, Japan has really pushed the limit on saying we're just not going to do that. The United States did the same thing back in the 1940s during World War II, as did a number of other countries. It's kind of repress interest rates well below the inflation rate and just kind of let bonds and currency inflate away for a period of time. And the reason that Japan was willing to do it is because, ironically, they want some inflation. from their policymaker perspective, they kind of want to burn some of that debt away. They want to let things run hot because they've historically had some of the lowest inflation rates. They're comfortable with that. If anything, it makes their exports more competitive now. And their main constraint is it basically makes their energy imports or their other commodity imports more expensive. That's kind of the biggest thing that they have to kind of are worried about getting disorderly. And so until it reached a certain point, they weren't really concerned about it. They kind of just let it play out. They didn't want to use their valuable reserves when they're kind of already getting what policymakers want, and they only would use those reserves when it got to a fairly extreme point, and there actually is starting to be some anger among people about the rate of their currency debasement, their inability, their reduction in foreign purchasing power and all that. So it kind of finally got to a level where they're not really alarmed per se, but they did begin to increasingly take actions to slow down or pivot that loss.
Why not try and clear some of the debt?
Because it's really hard to. It's on the public ledger.
Right.
So, I mean, they can't really. I mean, they don't really want to default on it because that destroys your global, your ability to borrow in the future for a long period of time. And so instead, they destroy it through debasement. Basically, anyone holding for long periods of time Japanese government bonds, your ability to buy almost anything else gradually deteriorates. So they're defaulting on people in very slow motion, which is generally easier to do than defaulting on people nominally, because then you actually have to admit mistakes. You get all the disruptions, you get all the problems. So instead, you can have a very high credit rating and just keep slowly rug pulling people as long as you can.
So, and who's getting harmed? Is it the middle class?
So Japan actually has less wealth concentration than most other developed countries. So in their case, it's basically anyone holding currency, anyone holding bonds. Many of them invest in foreign assets for that reason. But yeah, basically anyone holding um, Japanese currency and bonds basically has this gradual tax imposed on them, fairly invisibly. Kind of just is very mild, slow rug pulling.
Right. And has there been any response? Because Japanese are quite a civil nation, quite calm people. I can't even think of times where I've seen of any form of kind of like protests in Japan.
Yeah, they have one of the lowest kind of measures of political polarization, compared to many other places. They, I actually did a post on social media a while back, kind of when the yen was depreciating at the fastest rate, and I was like, "Hey, Japanese investors here, Japanese people here, how many people there are talking about it? What's the chatter like?" Some people said hardly anybody's talking about it. Other people said no, a lot of people are starting to notice. So obviously, it depends on people's social circles, how into finance they are, for example. People certainly notice it in terms of imports. And I've seen this on Egypt in a faster scale. Like I'll go when I'm there, I'll ask people like, what do you think of the debasement that's happening? That's happening much faster than Japan, and where people notice it is the imports. So, for example, in Egypt, people will be like, literally, car prices tripled in like 3 years. And that, it's not like, so like certain things like domestic food didn't really go up, or like the rate to hire another Egyptian to do something didn't really go up too much. But when you're buying a computer or a car, or even like wood, like foreign made wood, for example, these things would go up so dramatically, and that's where the pain points are. So my understanding is it was similar in Japan, just at a slower rate, because it's a wealthier society. Inflation was still fairly low, ironically, despite all that debasement. And really, the main parts where it can show up are in yen denominated energy prices, commodity prices, which can then kind of trickle into other things.
Right. Okay. And I guess even though they've got a fairly solid domestic car market themselves, the raw materials could be imported, so it would still impact it.
Yeah, I mean, it is those imports of raw materials are a fairly small percentage of GDP.
Right.
And they're a wealthy society, so they can generally absorb that, and it's less of a crisis than when an emerging market gets like higher energy
Mm.
prices in local currency terms. But yeah, if it goes on long enough and gets significant enough, that's when you do get more people kind of saying this is a problem, and then you're more likely to get the government saying, okay, now the risk reward is more in our favor to try to slow this down, make sure we don't have like energy costs get too high in yen terms, that kind of thing.
And what triggered this deleveraging?
A combination. One is that in the past number of months, Japan has been more directly intervening, like FX, like selling reserves to buy back yen. So there'll be these big bursts of like money, tens of billions of dollars being used, equivalent to support the yen. And this one seems to be triggered by the fact that they increased their interest rates from 0.1% to 0.25%, which is still very low, but
Yeah.
it's the highest rate in a decade and a half.
Wow.
And when a country has a structural current account surplus and then they're raising rates, they can actually be pretty impactful, given how leveraged that carry trade was, how big it was. So that seems to have been the proximate catalyst. And then there's kind of things that feed on themselves. So, for example, if various entities that have borrowed too much yen have to suddenly deleverage, they're selling some assets, which is then hurting other players that might have to then sell those assets as well. And it kind of feeds on itself. In addition, there was a separate kind of mini bubble, which was that a lot of traders globally were short volatility. Basically, they were structurally selling options, kind of like selling market insurance against volatility events. And so a lot of them got caught off sides by the carry trade, partially deleveraging. And so you get a carry trade deleverage, which then hurt a lot of these, short volatility entities. And so we got the third biggest volatility spike in U.S. history compared to a fairly mild event. I mean, the other two volatility spikes were 2008 and 2020. So we had a volatility spike that at least briefly got up to roughly that level uh, because there was these kind of imbalances, everybody on one side of the trade.
Right, but a 0.1% to 0.25% doesn't seem like a particularly big rise. So let me see if I've learned anything over the years with you. Is it a case of, even though it seems such a small rise, knowing the levels of debt that Japan has, that brings a huge amount of systemic risk into the Japanese market because of the interest payment, the difference in interest payments that will be and how that is funded?
So that is part of it. That basically that small numbers matter when we're talking
Yeah.
250% debt to GDP. In addition, there's psychological trend changes, like the straw that broke the camel's back, kind of, which is to say that this move in a vacuum might not matter, but when you saw in recent months that Japan is increasingly willing to intervene in its currency market and is now raising rates, it kind of shows that maybe they're not just willing to let the yen devalue as it was. When it was devaluing for a while, people were like, "Aren't they going to do anything?" And the answer kept being, "No, not really. No, they're just going to leave everything how it is." But it kind of showed that at these levels, it has gotten, somewhat of a concern for them. And so if you've been years, borrowing yen to buy other assets, and you're quite leveraged, and you start to see increasing signs that they're going to defend these levels to some extent, a lot of people at once can realize I want to get out of this trade, or I want to minimize my exposure to this trade. I want to deleverage myself relative to this trade, and like then it feeds on itself.
It sounds like an easy trade, but the risk is whether you do get caught short with it.
Yeah, it's kind of short volatility trades as well as carry trades. It's kind of one of those things, they work until they don't,
Yeah,
which is to say it makes sense to borrow zero yielding yen and buy 5% yielding dollars, right? And it's like, why wouldn't the yen keep devaluing relative to the dollar? But eventually it reaches such an equilibrium point where Japanese goods are absurdly cheap on the global market, so it can really benefit their current account, and then you also get more, willingness by authorities to intervene, and so what was once a very easy no-brainer trade starts to get risky, and if you're leveraged, a 5% currency move can wipe out a year of profits, for example, and
right.
so fairly small differences can really matter all at once.
And are we aware of anyone who got wiped out? Was is there any like public disclosures of people who are in a difficult position with this?
I don't think we've really seen the proverbial bodies float to the surface yet.
Right.
Japanese banks had some of the biggest stock price impacts on the day, um, but it's really a pretty broadly diffused trade. There's just a number of entities that had to deleverage that would have taken some pretty significant P&L hits on that day. And we've already seen a pretty sharp rebound,
Yeah.
but because a lot of that is now deleveraged, But there are kind of broader issues associated with it.
All right, so let's do both. So it was one. It was the I can't remember the actual stat, but it was the biggest drop uh, in the Nikkei since what, COVID or something
I
or
think
other.
1987.
Was
Yeah,
it 87? Okay,
I
so it
think
was worse
so.
than that. So worse than 2008. Okay, but it's bounced back pretty quickly. So I've got a couple of things on that. Firstly, why did it bounce back so quickly? But secondly, we've talked a lot about this in the past where economies start to fail, that you would expect to see a more kind of shorter cycles and this kind of yo-yoing between of rates. Is this what we're starting to see? Are we seeing something breaking in real time?
Well, I would phrase it a little bit different. I think a lot of people, I mean, when the yen was weakening, people were saying, "Oh, it's the end of Japan. All the stuff's kind of coming back to hit them now." And then, ironically, when we had this period of yen strengthening and the Nikkei down, people are like, "Oh, it's the end of Japan. All their stuff's coming back to hit them." It's like, well, what is it? Is it when it weakens, is it bad for them, or when it strengthens, is it bad for them? Like, what exactly are we calling, the crisis here? Um, I view this individual instance as less big of a deal than many market participants made it out to be, which is to say that this was a fairly mechanical shift. Um, there was a deleveraging that happened. There's probably more deleveraging ahead, but less abrupt because now the pivot is in place. Now the trend change is more obvious. Kind of like the fear of God has been put back into anyone who was running a leverage book. Like they're reminded, yes, there's risk. Yes, it kind of like changes psychology in the market. Um, and I think that I think Japan still has a big runway ahead, and all the different levers they can pull. Their stocks are not particularly expensive, right? So it's not like you're in the late '80s when they got their famous Japanese bubble. The valuations were silly back then. Whereas now the stock market is fairly reasonably valued compared to their cash flows and things like that. So it's not surprising that when there's a 12% drop, there's a number of people that say, "Wait a second, most that was almost entirely mechanical." So I'll go in and buy names that are inexpensive and oversold. There are unlevered entities could come in and take advantage of the fact that levered entities basically had to sell. Kind of like if you see a Bitcoin get a liquidation, if you're unlevered and you have some cash sitting around, some people will come in and buy it. So we've seen some of a rebound in Bitcoin as well. Um, and so I think that's normal. I think the bigger story is that aside from just the carry trade, the way that global finance works is that most currencies trade against each other based on interest rate differentials and current account flows. So if you're running a structural trade balance and your interest rate's not attractive, your currency is likely to weaken until you kind of find more of an equilibrium. The dollar has this extra monetary premium on top of it. As the most liquid, most attractive currency in the world, the deepest capital markets, there's a lot of entities around the world that hold dollar denominated assets. And so we get like a structural premium to our currency, which makes us really good at importing. We have tons of importing power, but it makes our exports less competitive. And so to meet that kind of global demand for dollars, we're kind of forced into running these structural trade deficits. And they accumulate over time. More and more dollars flows out into the world. They take those dollars and they buy US assets. And so everybody's kind of crammed into our stock market and our bond market and our private equity market and our real estate market. Everyone's kind of crammed in, but especially equities. Um, and so it's like a really kind of an engine that just keeps spinning. And there's a decent chance that can start to reverse in the years ahead. That as our economy slows down a little bit, as the weak exports weigh on our GDP, as there's rising political concerns around that trade deficit and the broader concept of reshoring and kind of actions we might take in terms of currency or in terms of trade to try to reduce that, you could get a partial, kind of flow out of that capital, which would be benefit some countries, but would harm others. And I think that we're probably on a setup like that. The last time we actually had a setup like that was after the dot-com bubble when the U.S. cut interest rates. In the late 90s and early 2000s, the dollar was very strong. And there was the Asian financial crisis because they all had dollar dominated debts. A lot of them blew up. But when our economy softened and we cut interest rates, it kind of gave especially the developing world, more breathing room on their liabilities. And so from, say, 2003 to 2007, there was an emerging market boom. That's where we actually got the term BRICS from. Everyone was like this, that was kind of a hot trade. That was like the Mag 7, or like that was the main trade of the day, was these booming emerging markets. And maybe on a smaller scale, we could get something like that again, which is if the U.S. finally runs into some economic headwinds, trims interest rates, some of this capital that is just so on one side of the boat, so stuffed into U.S. markets, could start to come out and go to certain pockets of the globe where things are cheaper, where their dollar denominated debts are now like under control, and you can start like a virtuous flywheel into those types of areas.
Would that not be net beneficial though? Yeah, rebalancing, because at some point, it's, if you go back to the market cycle. I mean, I know only the basics from Ray Dalio's market cycles, but you have to rebalance at times.
Yeah, I think basically it's more dangerous when you're in a very imbalanced condition. And so then the question becomes timing. There have been a lot of people calling for a rotation and a mean reversion of that trade. The last time there was a good window for it was 2019. That was the mid 2019. The Fed started cutting rates, so it was before COVID.
Yeah.
The U.S. economy was already softening. The Federal Reserve cut interest rates by late 2019 because the repo rate spiked. They actually went back to balance sheet increases as well. Um, and so, and you started to get this kind of mini, the dollar weakened a little bit. You started to get a little bit of a mini rotation into some foreign markets, but then COVID and lockdowns and everything. So that rotation never really materialized. A lot of countries were hit harder than that, especially developing ones, because of all the effects of that whole situation. And so this is probably the first window since 2019 where a serious possibility of rotation is at hand. And it's hard because you don't want to be, early. Like, in my base case in 2019 was, okay, look, we're probably going to get a rotation. Then, of course, the pandemic happens. You got to change all your outlooks. So there are certainly things that could derail that view. I do think a rotation would be healthy should it occur. Generally speaking, when you get that kind of rotation, so in the prior times where we had that kind of rotation, in addition to being good for those select foreign equities, it also tends to be good for commodities, gold, and presumably Bitcoin. Bitcoin was not around in prior rotations, but presumably it'd be good for them because you generally have a weakening dollar, and kind of just capital more broadly dispersed and a little bit of a boom.
Who's it bad for though?
Well, it can be bad for American consumers, right? The ones that have kind of been on the winning side of a lot of things. You can kind of get more inflation in the U.S. You can get more higher energy prices in the U.S. It's kind of like a band-aid being taken off because it does increase our export competitiveness to some degree. Um, so there are kind of winners and losers from that. But basically, if you're a foreign exporter, it might not be amazing, and if you're an American consumer, it might not be amazing. But it's kind of so imbalanced right now in favor of foreign exporters, and in favor of American consumers, and it kind of reaches like a breaking point eventually. And those groups generally will not love that type of period, whereas anyone who's a consumer in all these places with weaker currency, they generally do better. And American exporters could maybe not do amazing because we've got structural issues there, but they could get breathing room. For example, all else being equal, it's some tailwinds in their favor.
And American consumers have already been hit pretty hard the last couple of years with high inflation. I've seen it myself traveling to the US. I'm just amazed at the cost of everything. It's kind of mind blowing. Even going for a Starbucks, you just cannot. Like, me and Danny will go and we'll get a couple of coffees and a couple of sandwiches, and it's like $40. You're like, what the fuck? What have I spent here? How's that happened? Um,
That's true, but it's on a relative basis. American consumers have generally done better than other countries, especially when looking at global purchasing power. So, for example, our ability to buy energy has generally been better
mhm.
than, say, a Japanese person's ability to buy energy.
Or
Um,
ours over here.
or Yeah, or Americans' ability to travel abroad. It's easier for us to go to Japan or go to Europe than Europeans or Japanese to come here, let alone emerging markets. And so, especially on the upper half or upper third of American consumers, that's where a lot of the strength has been focused. And they could take, a fairly big hit. That if you have a cycle of capital outflows, and again, I don't think it's going to happen overnight, but if you do get one of these more sustained flows, like we did in the early 2000s, a lot of those kind of upper middle class American consumers that have been able to fly everywhere, buy whatever they want, energy's cheap. Um, some of them run into issues, and unfortunately, it will also impact some of the lower income consumers that have already not been in great shape. And so that's the type of where there are winners and losers. Now, some of those lower income consumers could be offset by the fact that there's more exporting jobs, for example, maybe more manufacturing things like that. So more opportunities for income, but also damaging to their consumption. But at the end of the day, a lot of this isn't really intentional. It's just kind of like imbalances in the system potentially reverting back when they can no longer be sustained. Like when the rubber bands stretch really far and you're trying to hold it and your muscles are getting tense, eventually it just kind of starts to you kind of let go. And that we could see something like that ahead. I'm kind of monitoring for signs that as the U.S. cuts interest rates in face of a at least somewhat softening economy, I'm going to pay attention to really how that affects some of these dollar indebted countries that have otherwise held up pretty well, but that are kind of under the boot of a strong dollar.
So what are those signs of the struggling economy? Because there has been talk of recessionary pressures. It feels like for quite some time now, and there have been calls for the Fed to cut interest rates. People are expecting a change. Like I think I saw this week the calls for like 50 basis points reductions in interest rates. What are the signals that exist right now?
Well, so yeah, the market is now pricing in probably a 50 basis point cut in the next Fed meeting. Um,
And
the
that would be a
signs
significant cut, right?
that would be, yeah. I mean, it wouldn't be that significant considering that they're over 5%, so it's less than a 10% reduction in interest rates. So it wouldn't be that unusual, but it would be interesting to go from 0 to 50 basis points that quickly. And so the signs generally are, the US, because we're running very strong, like very loose fiscal policy and really tight monetary policy, we've had kind of like two different types of economies in the US. If you're on the right side of deficits, you've been doing pretty well. Meaning, for example, if you're catering to upper middle class travelers, the travel industry's been doing great. Whereas the commercial real estate market's obviously been terrible, and the manufacturing sector has been in basically a mild recession for like a year and a half. Um, and the labor markets have been fairly strong. The consumer, especially the upper half of consumers, has been fairly strong. But what we saw in the last week was manufacturing weakened more than most economists thought, and um, payrolls, like jobs, weakened more than most of them thought. And so, we started to get that probably contributed to some extent to the yen carry trade unwinding as well, because in addition to Japan trying to tighten their own currency, we also got weakness in U.S. markets, more rate cuts priced in, and therefore that contributed to a weaker dollar there as well. So you have kind of a one-two punch. Um, in addition, partially because of this, carry trade unwind, we got a uptick in credit spreads, which is basically saying that the interest rate gap between junk credit and like say treasuries widened. It's still fairly low, but it's now moving in an upward direction, which is generally signs of basically financing stress in some of the more sensitive parts of the economy. So there's a number of things that are kind of pointing to at least gradual economic deterioration in the U.S., which generally leads to interest rate cuts and just kind of more accommodated policy, which it might not even be that helpful for a lot of U.S. businesses, but then ironically could, as I mentioned before, boost some of those emerging markets that have dollar-denominated debts.
So it feels like it's almost like like a relay, and that the baton is just being handed on to other markets. In that the US has a weakening economy, reduce the interest rates, stimulate domestic businesses, hand the strength back over to other economies, and when the US strengthens, like the reverse will happen. Is this just like a global relay? Just pass the baton on.
That is how it works. It's kind of this control system, and it kind of floats
Mm.
around. And so, for example, in the 80s, there's really kind of Japan was kind of pulling everyone along with their massive like industrial base, and their asset prices doing really well, and just kind of dominating all the stuff they're doing. In the 90s, the baton really passed to the U.S. Um, and then when we kind of softened in the 2000s, then you got the BRICS were really kind of running the baton, And then after the global financial crisis, kind of the BRICS, they did less of it. It was really kind of China focused for a while. China was kind of the world's growth engine, them kind of pulling everyone along. In this upcoming one, China's probably not going to play as big a role as they did in the 2010s. They might have their consumer might pull things a little bit, but their demographics and their debts are more of an issue now. It could be the Indias of the world, it could be Latin America, it could be parts of Africa, kind of a more dispersed. But basically, some of these economies that have decent demographics, that are reasonably well governed, that are just kind of held down by the fact that they borrowed in dollars and then those dollars got stronger. Um, this is a pretty consistent pattern that happens every 10, 15 years or so. You get a little bit of a rotation.
Is there any significant global threats? Because the reason I ask is it feels like everyone's kind of a little bit jittery, and like Japan said boo, and the rest of the world freaked out. Are there other big structural issues, and could we have something similar to 2008 but much worse?
Well, I think a lot of countries are in a similar position as Japan, but just less thorough, right?
Okay.
So I think U.S. debt to GDP is a problem. European debt to GDP is a problem. And while we are stronger in some areas than Japan, we're weaker in other areas. So Japan, like I mentioned before, they're a huge creditor nation. They ran structural trade surpluses for years. That's how they build up this big war chest of all these foreign assets that they own. They're very high public debt, but they also have very tremendous amounts of foreign assets. Um, and the United States is actually in the opposite position, which is that we ran structural trade deficits. So we're running twin deficits. And so, even though we have better demographics than Japan, we have more energy security than Japan, we have, like, less public debt to GDP than Japan. We also have this trade deficit issue. We have more political polarization than Japan. We don't know what's going to happen with the upcoming elections, and then even if however they go, we don't know who's going to accept it or not accept it. We have just kind of a lot of mistrust, a lot of lost faith in institutions across the board, and so I think it's right for people to be jittery. In addition, of course, there's really ongoing war in Eastern Europe and ongoing conflict in the Middle East, with increasing instances of escalation, especially in the Middle East in recent times. And of course, anything that damages the flow of energy globally can be a big problem for a lot of energy importers. And so there are heightened risks, I would say. One of the basically, as we get to kind of late 2025, the Federal Reserve might have to go back to balance sheet increases for treasuries, which could be a problem if you still have above target inflation. So I view it less like 2008, because that was a private sector debt bubble. So private sector debt bubbles tend to be big deflationary events, whereas I view now most of the problems are on the public ledger, so very high public debts, which when they have issues tend to be somewhat more stagflationary um, when they unfold. Now, obviously, there's different things that could happen to adjust that, so I monitor things as we get it, but I do think that it's not quite the same as 2020 or 2008.
Are you following what's been happening in the UK?
To a moderate degree, yes. I'm sure not as close as you have, but yes.
Yeah, so I was discussing it with my son this week, and he was asking why it's happened, what's going on, and like on the face of it, it feels like polarization. Uh, Certainly, between there's a right wing element to it, but there's also a youth element to it. So you're seeing clashes between groups of what are considered far right protesters and Muslim communities. But also, when you see the footage, you actually just seeing a lot of young people, what we would call yobs, young people with hoods up and their faces covered, lobbing bricks and looting stores. And so I was trying to explain it to my son. I said, "Look, there's lots of things going on here, and there's lots of ways you can look at it. There's a lot of nuance to it. We had a sadly in Southport, we had a stabbing where a young man went into a community group and stabbed three young girls. Like terrible event, and it was very quickly jumped on with misinformation, blaming it on a Muslim person. That's created this kind of conflict and tension. But when you layer in, there's lots of young people also going out and looting stores and lobbing bricks and fighting the police and seem to be enjoying it. I said to him, part of this, I think, is an overall tension uh, that exists within the nation, and it feels like it's more working class communities. But I know, for example, with the businesses I have here, I've seen the inflationary pressures. We have less people spending money, and when you ask people why, they say, "Well, my rent's gone up or my mortgage has gone up, and I can't afford it." And so I've got this kind of like underlying feeling that really what's going on is that it's like there is a match which is like striking the tinder, and it's like creating uh, these moments where it's where people are protesting or fighting, but I feel like it's a tension that's been built in them economically.
Yeah, that's I mean, one of the quintessential examples I turned to is some years ago in Chile. They had massive protests. There were the trigger was basically it's like train prices went up by like a nickel,
I was
right?
there.
But of course, yeah. So you were okay. So it wasn't the nickel.
Yeah.
It wasn't the nickel that did it. The nickel was this catalyst for accumulated frustrations that people had, um, and that's I think what we're seeing now in some developed countries. We're seeing it in the United States, we're seeing it in the UK, we're seeing it in parts of continental Europe, um, and basically, there was this chart I saw. It was Michael Green that shared it. Basically, it's like it was America, but it was like real disposable income after like shelter, food, transportation, and all this. And it shows that ever since about the past 10 years or so, it's been going kind of sideways to down, which means that most people's everyday experience of and it's like the median person. So most people's everyday experience of affordability and quality of life has not as it went from structurally improving to not really doing great. In addition, in the United States, it's kind of the first period of time where life expectancy is actually going down to some
Weird.
extent, which is a really bad sign. Um, UK is in a similar position to the US where you have trade deficits. So you've had a little bit of hollowing out of your industrial base, which you've kind of observed that as well. It's just kind of like industrial towns on harder time, working class. So it's a similar position as the United States, and so people increasingly sense that something's wrong. They're not really sure what it is. Like, they're not really sure what mechanisms are there. And then you get more distrust in institutions. So both the US and the UK and elsewhere, people that say, I think government's doing a good job, or I think the media is doing fair reporting, or I trust medical authorities, or I trust, you know, whatever the case may be, across the board, that trust is generally declining to fairly very low levels. More polarization, more frustration build up, economic frustration, and then you have like very real policies that do people do have say rightly criticism of, like how immigration's good, but if you immigrate a ton of people all at once and there's a lack of assimilation, people can I think rightfully get concerned about that to some extent, and of course it can be taken out in harmful ways. But then people start debating, well, what's going on socially while all these other economic things are happening, and then people can unfortunately take it out in violence and hate
Hmm.
when it's some of these problems are very hard to solve. And I tie a lot of it back to broken money, not everything,
Yeah.
but if you kind of catalog over time, over decades, as a species, we consume more energy per capita, so that's good. Our technology is way better than it was years ago. Some of it's actually got harmful effects, but either way, we at least have better technology than we once did. But our money's like worse than it was
Hmm.
a while ago, especially if you're outside of these major countries. But in general, money's bad. It's like that one area where technology's not really made it better, um, and it causes all these imbalances and all these one part of the economy gets hollowed out, and this other thing has like this unfair advantage, and then it kind of rotates, and these big forces happen around them, and they don't really know how to frame it, how to contextualize it. It's much harder to have debates over fiscal policy than it is to have over social war stuff. So when the fiscal policy or just the overall economic situation, when that gets messier, fewer people are able to articulate it. And so they articulate it in more visible ways, more social ways. That's where a lot of that anger gets expressed a lot of the time.
Well, look, I mean, we said at the start, we've done 37 interviews now on this, and I've essentially been fortunate to have you almost like a one to one mentor for the last 3, 4 years where I get to ask you every question. But it's a lot to take in, it's a lot to understand, it's complicated. mean, I'm trying to explain it to my son, thinking I wish Lynn was here. She'd do a better job than me. But it's a complicated thing to try and understand. I was trying to explain it from a personal perspective, in that as I'm a taxpayer, but also a business owner, and I, my my corporate taxes are going up, my personal taxes are going up. It's getting harder to get rid of staff, but I have to pay my staff more. Yet we've got less money coming in. There's economic pressures in every direction. Essentially, less money coming in, more money going out. Very hard to streamline your business, and and trying to navigate this path is getting kind of tighter and tighter. You know, when you see like in a film, there's walls that close in, and someone's trying to run through it. That's what it's starting to feel like. And trying to explain that or articulate that to people is very difficult. And I think, like you say, the social issues are easier to argue. Yet we're sat there with political parties who are incentivized to tell us what the problem is and what a solution is. And it seems to be almost that there's now an opportunity for, yeah, well, not an opportunity, that certain politicians are using this as a way of driving votes. And I just feel
Yeah.
like this doesn't have a good historical precedent.
Historically not. Historically, you tend to
Yeah.
overshoot, right? So the pendulum goes to one side, people want to go break it up, and then it swings to the other side, and people can misdiagnose the problem, blame the wrong groups, and it can get unfortunately pretty dark, um, to say the least.
Yeah.
It's when the pie is growing, people are way more accommodative. They might be frustrated about this or frustrated about that, but the pie is growing, things are getting better. They're optimistic that their kids gonna have a better life than they had. People are more tolerant. When that pie stops growing, or it starts shrinking, and we get a more of a zero sum game, that's when people start finding someone else to blame, wanted to take away from someone else and give to them, because it's kind of the only way that they that they come out better, because the pie overall is not growing. And again, there's a lot of, it's broken money. I also think it's broken energy policy, right? That a number of countries have not managed their energy well. They get into this like mindset that like the only thing matters is, say, carbon emissions, right? They try to quantify everything by one number. Like, most people, if you ask, do you want to keep the environment healthy around you? Do you want to have clean air and fresh water? And of course. But then so many politicians put it into one number, and then they'll base all this energy policy around one number. And at the end of the day, if people, if their energy costs are going up, if their, their real standard of living is running into frictions, that's when they're willing to take it out. Not just on, maybe they are protesting around energy prices in some cases, but they're also then look around and saying, well, who's eating my lunch? And they might blame someone who's not eating their lunch, but someone's got to be eating the lunch. And so you start to get more like, issues. And of course, then you can tie it also back to see real, questions around how should we structure immigration policy, or what, there's, legitimate concerns there, I think, but it can get taken out in very destructive ways when a lot of things
Mm.
happen at once.
I saw a really good meme today on Twitter. I don't know if you've seen it. It's a table. There's a politician in the middle. There's a white guy on the right and a Muslim on the left. And the Muslim's got a plate with a cookie, and the white guy's got a plate with no cookies. And the politician's got a plate full of cookies, and he's saying he's taking your cookie.
Yeah, there's actually, and I saw a video. It was like a dog was eating from like food, and another dog came over and attacked it, and they're like then barking and yapping at each other and fighting, and this third dog just kind of came over and ate all the food.
There you go.
And it's literally like, there's always, it's misdirection. That's how a lot of politics works. It's very kind of misdirection oriented. Like it's their fault, go after them. And it's politicians rarely will ever take responsibility for things they did. And some of these things politicians might not even understand, like some of these financial plumbing stuff. It's like most people don't want to be a chief financial officer on their side, in addition to whatever other their main area of focus is. And so that's kind of why it's easier to blame the social issues than some of these more economic issues.
Yeah, but that comes. I mean, I'm when I was out in Argentina. I don't know if I've told you this. I went out for dinner on the first night. I was with my friend Juan and his friends, and they all said everybody in Argentina has two jobs. They have their job, and then 30% of their time they're a financial director. They're having to manage their money. And by the way, sorry, just to go back. So, is that the second book, Broken Energy?
Actually, Eric Townsend of the Macro Voices podcast
Yeah.
suggests I write that book. I mean, probably not, but we'll see.
But
It would
but
be
it
an
is
interesting book, I think.
so it is broken money, it's broken energy policy, but it's broken media. But is broken
Yeah.
media just downstream of broken money? It's broken politics. It's like it's all been broken.
Yeah, I mean, I think so. There's that book, Fourth Turning, which you're familiar
Yeah,
with. The
yeah.
reason I think that there's an element of truth to it is that institutions can develop entropy, which is to say that they're built in a certain era. It kind of makes sense in that era. And then over time, they are antiquated. The world has moved on, technology's moved on, things have moved on. Their own internal things just get kind of like corrupted. Companies or organizations or governments rarely disrupt themselves, right? So if you're like a paper maker, you're probably not going to invent email, right? Um, you're gonna want to people to use all your paper all the time, right?
Yeah,
So companies rarely it's usually startups that disrupt incumbent players. It's very rare for that not to be the case. Um, and that same is true for governments. The same is true for supranational organizations. The same is true for old school media. There's rarely enough like self reflection, intentional self disruption, and staying vibrant and changing. So normally, what happens is you kind of replace. You get to a point where it's so out of touch that those other institutions either get taken down or just become irrelevant, and new institutions get built or new and an institution can be multiple things. It could be a way of thinking. It could be an actual institution, but it also could be a way of thinking. It could be a protocol. There's all these things that you can kind of orient around to say these are kind of pillars of society that are now considered more structurally relevant than things that were, put into place a century ago.
President AI.
Well, I hope not. There's that old IBM quote: "Never let a machine make a decision because a machine cannot be held responsible."
Yeah, but
Yeah.
we're struggling to hold some of these politicians
Yeah.
responsible. Okay, so what does this do to your Bitcoin thesis? Because at a time where things are breaking, and by the way, I've had two emails today alone. They're basically asking you this question: is like, well, what about the Bitcoin thesis? Because when things break, Bitcoin dumps the most. Danny told me he read a very good, I can't remember who tweeted it. He said he had read a very good thesis on this, in that Bitcoin being the most global liquid market will always respond best to what's going on in the global economy. But either way, it's the people who've written to me have said, well, every time something breaks in the economy, it's Bitcoin that dumps. So I thought Bitcoin was meant to be the lifeboat.
Yeah, so one is, yeah, Bitcoin provides 24/7 liquidity. So on a Sunday night in America time, while Japanese Monday morning, while they're blowing up, the safety option is that if you hold Bitcoin, you have 24/7 liquidity if you need it or want it, which you don't have with almost any other asset. The downside is in terms of price, it's not great for those that are still holding. It is good for those that like to buy dips. Um, I generally don't view Bitcoin as being a risk off asset in the way that that portfolio people would think about it, meaning that price normally goes up during crises, because it's still not well understood. It's still, it's just sometimes there's leverage in the space. Um, One thing I point out is that there's like pro liquidity crises and then there's anti liquidity crises. Most crises are anti liquidity, which is to say that Bitcoin's biggest correlation from what I found is liquidity. And when a crisis breaks out, normally it's not good for liquidity, and so Bitcoin's gonna be one of the first things sold, especially because it's like that phrase: you sell what you have to, not what you want to. Especially if we're talking about a 24/7 market on a weekend. Um, and just a volatile asset. As long as Bitcoin has upward volatility, which we want it to have because we want it to
Mhm.
get much larger, that's going to come with periods of downside volatility. And then as long as it has both upside and downside volatility in large amounts, people are going to often treat it like a risk asset until it kind of reaches some much larger, more distributed, steady state, or at least like kind of gold like in size. Um, an example of a pro liquidity crisis was ironically the 2023 American regional bank crisis. So Bitcoin performed poorly in, say, late February and early March because that's where actually liquidity was worsening under the surface. But when the crisis actually hit, Bitcoin did well. And that's because the market immediately realized, okay, the Fed and Treasury are going to provide liquidity. Things broke. and they kind of knew that that's something they had to respond to, and they did. And so Bitcoin did quite well after some hours. It actually did quite well pretty quickly because that was a pro liquidity crisis. Things like the COVID crash or things like this dislocation we just saw. These are generally anti liquidity events. So we should not expect Bitcoin to do particularly well during them. It still serves its function of giving people 24/7 liquidity should they need it or want it. But I think it's more like, and I think Parker Lewis has said this, it's not a hedge, it's a solution in the sense that this is an alternative system that's being built. And so I wouldn't think of Bitcoin in anything less than like 4-year increments, um, because it's a structural, as long as the thesis is correct, it's a structural growth story, but one that is likely to be sold during most negative liquidity crises.
So you're buying for problems 4 years down the line.
Yeah, yeah, and you're buying a solution for like if money's broken, you buy the least broken money, buy the good
Yes.
money. You try to build systems. Like when people ask me, "What do you think about this recent Bitcoin price drop?" and like my answer is like, I hold keys in geographically separated areas. I invest in venture, with ego death capital for like decade long, like intended timelines. Um, it's that's the kind of the time frame I'm thinking of when it comes to Bitcoin. And I generally warn that in any sort of intermediate term sense, Bitcoin is highly correlated with liquidity, does not do well usually during bad liquidity environments. If we do get this more gradual rotation, like if for example, if the U.S. trims interest rates in response to weakening U.S. activity, and we start to get some life out of emerging markets because their dollar denominated debts are eased a little bit, and you start to get that kind of flywheel of, oh, look, investors say, oh, look, they're doing decent. I can take some money out of overvalued U.S. stocks and put it into country XYZ. Then that ironically strengthens their currency even more and weakens the dollar even more, which is good for their dollar-denominated debts. And so you get this kind of self-reinforcing flywheel. That would be probably a quite good environment for Bitcoin.
Yeah.
That'd be an environment where foreign equities are doing decent, gold's probably doing decent, Bitcoin's probably doing great. Um, that's where that would probably be paying off pretty well. In this current period, is the last few years, as good as Bitcoin was in dollar terms, it was even better in yen terms. If you're a Japanese person holding Bitcoin, you're like a king or a queen relative to
Hmm.
what most people around you are experiencing. If we get that other type of rotation, you could have a similar thing. So I'm quite bullish on Bitcoin with, I guess the shortest time frame I give is maybe 2 years. I'm saying, okay, I'm bullish on Bitcoin with a 2-year view. But more realistically, I look out several years and say, well, I think global liquidity is going to be higher years from now. I think Bitcoin's going to be higher, but I don't expect it to be a risk-off play in the price sense, unless a particular crisis happens to be one of the fairly uncommon pro-liquidity crises.
Hmm. All righty. Well, listen, look, that's it. 37 shows we've done. That feels like a good time. I want to end on Bitcoin. I did have other questions, but I want to end on Bitcoin. 37 shows, Lyn. It's quite the catalog.
That's quite a lot. I would have guessed 20, I think. So
Yeah.
I undershot that quite a bit.
I just checked the website. There's a rumor we're launching a new show, so we may get you on that at some point. But
I've heard the rumor. Well,
we'll have to
good
get
luck with
you.
it.
We'll have to get you over to the UK for that because I'm not traveling anymore.
Makes
Lyn, it's
sense.
been an absolute pleasure over these last few years making these shows with you. But we
Yep,
will
same on my
remain
side.
friends.
The
I will
fact that I
see you.
didn't know how many it was shows how much I liked it because it shows it never got old.
There
You
you
know,
go. Well, look, a lot of people have got a lot of value from it. Do you know what I'll do? I'll go and get the total downloads for you at some point. It would be, I would guess, millions and millions. So we will get those numbers for you. But we will stay friends. I will see you in various places like Norway, but I'm going to be traveling less. But when you're next in the UK, we will try and find a way of going through and turning all 37 shows into one at some point.
of course.
Right, you're the best, Lyn. I adore you. Thank you. Congratulations on the book. I love everything you've done, and your career trajectory has been incredible. And long may it continue.
Thank you, and congrats on your kind of show changes and all that you've done.
All right, peace out.